subscribe now and press the bell icon. Never miss an update.
We stopped here, right? What is the lump sum? What is the residual value and all? Anurag, do you remember? What kind of order do we need to follow to get to residual method?
It is relevant to goodwill, how the company
Okay,
is.
right. And how is it being calculated?
When the purchase price is lower than the aggregated fair market value of the asset, other than the goodwill.
Okay, that's not right, but whatever. Okay, fine. That's not right. That's not what I'm asking. You cannot be that specific. I mean, residual method applies in any situation. We are just talking what is the order of the assets that we need to take while we are calculating the residual value. The fair market value can be higher, lower. How does that matter? So, and then obviously, if the fair market values, the
First, we
value,
will take cash,
yes,
then
then
Marketable
we are cash
securities.
items, right? In order of liquidity, we need to go all on this, from these classes, class 1 to class 7. So the most liquid item on the top that needs to be first, considered as far as purchase prices. We need to consider the most liquid item from the purchase price, reduce it to see what we come up with next. Go in the sorry, go in the order of liquidity, and then see, like, are we left with a surplus or we are left with deficit. Accordingly, we need to take call whether we need to spread accordingly on the leftover assets, whatever that purchase price is left, or if we are purchasing the assets for a higher price than what their fair market value is, then obviously we are giving a premium. That means we are buying goodwill. Whenever the price is high, that means we are buying goodwill as an intangible asset. So the remaining portion goes to goodwill. That's what the residual will. Clearly, the name itself suggests what is the residue there, what is the remaining portion. That will go to the last item, which is going to be goodwill. Right? We have seen this example yesterday. And so we're not going to go over that now. We have seen demolition, all the cost loss associated with demolition structure will always go to the land. That gets added to land basis. It will not come to the building and all. Okay, let's look into this property received by gift. So there is an annual exclusion limit in US. I think it was 15,000 per person last year. Otherwise, it's not. But 2022 is 16,000 per year. So any gift given up to $16,000 is not going to be taxable, and these limits are applicable on the donor. So, oh no, wait a minute. This is applicable to the recipient, any person, but the donor, it can give to like 2 or 3 people, but it cannot be more than 16,000 per person. Okay. So anyway, we are not looking into that right now. We have the entire chapter based on gift tax. That time we'll see how the 16,000 is going to be calculated and how does that apply and all those things. But one person cannot receive more than $16,000. Otherwise, the gift from another person. Otherwise, the gift tax may be applicable, and the gift tax is paid by the donor, not by the recipient. So right now we are just looking into the basis of the property. If the property is given as a gift from one person to the other, how do we calculate basis? So what we need to do is the donor's basis in property acquired by gift is the donor's basis. Whatever that property, whatever the cost that has been used to acquire the property by the donor, that will also become recipient's basis, donor's basis. Increased for any gift tax paid if the transaction is going above that limit. If there is a gift tax that comes into the picture, then we have to see what is the gift tax that has been paid, and that gift tax need to be added to the basis of the property. So then donor basis is increased by the gift tax. Now again we have to see any gift tax paid attributable to appreciation. That means if the fair market value is going to be higher, if the property is appreciated in value, we need to first find out what is the gift tax. We need to see what is the gift tax applicable on the appreciation. Okay, and that value gets added to the donor's basis. We'll go over that. This is an example. This is a formula that they have put up. What is the fair market value less adjusted basis divided by fair market value minus annual exclusion. So obviously this will come up when fair market value is more than adjusted basis, because that's where the appreciation is happening. Fair market value is higher than the basis. Maybe we bought some stock for $10,000. After 5 years, maybe those stocks went up to the value of 25,000, and the person decided to gift those stocks to relative, friends, or somebody. So in that case, the property has been appreciated. Fair market value has gone high than the basis. The basis was only $10,000 to acquire it. So we'll go over this example later. Okay, now let's see if the FMV is less than the donor's basis. That's where it gets a bit tricky. We'll go a bit slow on this because it could be a bit confusing. If fair market value is less than donor's basis, the example right now I gave is fair market value is 25,000, basis was 10,000. Here, fair market value is higher than basis, right? Cost is 10,000. Fair market value on the date gift was given was higher. What if the fair market value is lower? That may also happen. People buy a lot of stock, say they bought it for $10,000, the stocks just, just plunged, and then there's not much value left, the stock market crashed or whatever, so maybe they got reduced to $2,000 or $3,000. In that case, and if the person says, well, okay, I don't want to keep it, maybe I'll just give it as a gift to somebody. So in that case, where the fair market value is lower than the basis, then what happens? Fine, that is understood. The fair market value is lower. But if it is given to donee, okay, person A gives gift to person B. In this situation, when fair market value is lower than the original, than the A's cost basis or adjusted basis, and later on, if B decides that, okay, I want to sell those stocks, maybe B is selling those, like when B received it, the value was say $3,000. And maybe after that, the market went high and B says, well, now it is $5,000, let me just sell it off. Or it went down, it became $1,000, and then say, well, anyways, it's not worth anything, let me just sell it off. Okay, but in both the cases, it is still below the cost basis. What if suddenly the market shoots up and this $3,000 worth of stocks, they become, say, $30,000? Then how do we compute the gain? Because see, when the person is receiving it as a gift, that is fine. That point of time, it may not be a taxable transaction if it is under the gift tax limit. But later on, when that person is selling off, that's when the basis really becomes important. And this may happen 5 years later, 5 months later, or whatever. It may happen anytime. So at the time of gift, we need to put in all these records in place that I received the gift on, say, June 15th, 2023. That point of time, fair market value was this much. The person who has gifted me, that person's basis was so and so, and keep it in your records. Maybe because 5 years down the line, 10 years down the line, if you want to sell off that, how do you compute gains and losses on that? It will be very difficult. Oh, well, I don't remember. Maybe something happened. Maybe I don't know. Maybe I just got that as a gift. I didn't pay anything. Maybe then just put $0 as your value, and entire money has to go for tax. But that's not true. If we don't maintain the proper records, maybe we'll end up paying high in taxes. But if we maintain proper records, we can see what the rules are, what basis taken, because the basis will get transferred from donor to donee. So we can always, make sure we are optimizing on our taxes that way. So it's keeping records is very important. If any of your client comes and says that, well, I'm going to give gift or I'm going to receive gift, okay, then have all these things in order. Keep it somewhere, because later when you're selling off that property, it will be very handy. Otherwise, you will pay tax on the entire amount of sale. Because how do we prove IRS tax? Okay, so this is something different situation. Let's go through it very slowly because it can be confusing. What is called loss basis? If the fair market value at the date of the gift is used if the property is later transferred at a loss. If later on the property is transferred at loss, we will go with the fair market value on the date of the gift. So if the property is transferred at a loss, say $1,000, they're transferring the property, then what was the fair market value? It was given at the market value of 3,000. So 3,000 minus 1,000, that is called the loss basis. 2,000 would be the loss. Gain basis, the donor's basis is used if the property is later transferred at a gain. Donor might have bought it for 10,000 in our example. And we will use that basis if the property is transferred at a gain. If the property is transferred for more than fair market value on the date of the gift, but for less than the donor's basis, somewhere in between. So in our example, fair market value was 3,000, donor's basis was 10,000. And the donee decides to sell it for 7,000. So this is between 3,000 and 10,000. If that is the case, then what IRS is saying, don't recognize any gain or loss. But just imagine if you don't know these rules, or if you don't have the proper information with us, and the gifts and all, usually it's not like, it's not an annual transaction. Right? It may take a lot of years for a person to sell it off and all. So if this information is kept properly, we can save a lot on the taxes. Okay. So let's go over this. Some uncle, he gives his niece a vehicle. What basis should she use if she decides to sell the vehicle, and how can she determine a gain or loss on a tax return? So imagine on the date of the gift, the fair market value is $10,000. Okay, on the day of the gift, the fair market value is 10,000. They did some internet research and all, whatever they found out, that it could be reasonably concluded that fair market value is 10,000. But the uncle paid 40,000. Obviously, if it's a vehicle, it gets depreciated. So uncle must have paid 40,000 years ago, maybe 10 years back. He bought this vehicle, and now he's got a new one. So he's saying that, okay, I'll just give it to my niece. $40,000 he bought it for, and the niece took it, but then she says, well, it's not good enough, it's like a lot of problems coming up, whatever, she wants to sell it off. So she decides to sell it for 9,500. Okay, so she's selling it for less than the fair market value. Again, the price went down, maybe it got depreciated more. She's selling it for 9,500. So she can claim a loss of $500. The basis is fair market value because it was a fair loss. That's fine. We just need to understand that this is a loss situation. The fair market value is used if the property is later transferred at a loss. So if she's transferring at a loss, then we are going to compare it with $10,000. We are not going to compare it with $40,000. We will compare 10,000 and 9,500 and see what is the difference that can be taken by her as a loss on her tax return. Okay, let's go to the next level now. So now they imagine the same fair market value, the facts are same, fair market value is same, adjusted basis is same for the uncle, but Well, the niece thought, wow, I got a jackpot. He just, something happened to that car. Maybe it became antique or whatever, and she was able to sell it for $41,000. Even higher than what his uncle has bought it for, what her uncle has bought it for. In that case, it is a gain. So, in the case of gain, the donor's basis is used. So now we are going to compare 41,000 with $40,000 only, not with 10,000. She's not going to put 31,000 as a taxable gain. Her gain would be only 1,000. Okay, so that's a very good situation. The gains are being minimized here by following this rule. And the loss is also being minimized, right? It's not like she's able to compare this 9,500 with 40,000 and she wants to claim whatever 31,000 or 30,500 as the loss. No, IRS is not allowing that. IRS is saying, no, you cannot claim so much of
मेरे को
loss.
लगता है यहाँ पे कई
When you got it for it was $10,000, yeah, that's what only $500 of loss will allow.
इसके फॉर्म में तो
But the same fairness they're showing at the time of having a gain.
सिर्फ इसको इधर कर दे.
Okay. Now the situation, we will think about this situation. The property is transferred for more than fair market value, but less than the donor basis. So somewhere in between. So the property will be later on sold for some amount which is more than $10,000, but less than 40,000.
इसको नीचे करूँगा तो ये भी नीचे होगा इसके जस्ट सामने.
Imagine the same fair market value 10,000 and basis of 40,000, but the sale price falls between fair market value and the adjusted basis. Maybe it's like $20,000. Okay, let's say it's 20,000 because in it is in between these two. Then the niece doesn't have any gain or loss. Okay, she doesn't have to report any gain or a loss. Okay, so we'll go over some examples. Maybe we'll do only gift tax today. Okay, we'll not, or maybe we can finish this. But inherited property is again going to be a bit complicated. The rules are very different. What happens when the person dies and all those things, that's something we'll cover up tomorrow. So we'll just focus on gift tax or basis for gifted properties. Okay. So depreciable basis is transferred basis adjusted for gift tax paid. Whatever that person who is giving gift, who's receiving gift, that person can also depreciate the asset if the asset has been used for business purpose and all. Obviously, if it's used for personal purpose, there's no depreciation. Right? We cannot claim depreciation for a personal purpose. If the gift property is immediately used as a business property, so imagine the niece is getting the car here, niece is getting car, and niece is running some business, and she says, well, yeah, this car could be my business property. Maybe she's going around and doing some tutoring work, so she can take that as the car is really required for her to do her business, or maybe providing tuitions, whatever. So that gifted property is immediately used as business property. So the basis for depreciation is the donor's adjusted basis. So what she can do is she can put $40,000 and every year she can claim depreciation on this 40,000. Because this has not been claimed. It's not like IRS is giving extra benefit. The donor never claimed depreciation on this. Or maybe he claimed depreciation, or maybe this amount is net of depreciation. Maybe he bought the car for $100,000, 60,000 went into depreciation, adjusted basis on the books is 40,000. If it's immediately used as a business property, yeah, she can take the basis of her uncle and she says, fine, I want to claim depreciation. Just imagine how much difference it would make on her tax return if she was not allowed to claim depreciation on this price, and if IRS says that you have to just go with the fair market value. Depreciation 10% may come up to 10,000. Here it could be 4,000. So immediately she can use donors basis. But if the gifted property is later converted from personal to business use, maybe after 2 years she opens up a business and she says, "Well, I have this car, I can convert it to business use."
रवि भी
Then
आएगा
the depreciable basis is the lower of
नाम भी आएगी नितिका मैम
adjusted basis or on the FMB on the date of conversion, not on the date of gift. We are not going to take this price as of or fair market value as a date of gift. If it is later converted, we have to see on the date of conversion what was the fair market value. Lesser of these two. And that amount can be taken for a purpose of calculating depreciation. Okay, we'll just take a break here. Any questions anyone has? This is, and I completely understand it could be a bit confusing because we don't even do that on daily basis. Whenever there is a gift tax kind of issue or the person is selling a gifted property, which is very commonly seen. A lot of our clients are coming and saying, "Oh, my parents," because our parents are getting old, so they, this is a very commonly done strategy. The parents are going to gift it to their kids, and later on, at the time of receiving gift, it's still okay, but later on they may want to sell it off. Then how do we calculate their gains or losses? So we need to understand these rules. We need to tell them that, okay, when you are receiving the gift, make sure you're having all these numbers handy. What was the market value? How did you come up to that market value? Do you have any circular, any kind of publication that this is the value, or any kind of department issuing something? Maybe the land department, or they call it circle price or something else, right?
बैलेंस शीट पे 80 पे
And how much did your parents buy it for? That also you need to have, because these transactions may happen after 20 years. Who remembers that? There's no way for anybody to go back and remember. Then what do we do just to cover ourselves? We say, okay, just put everything as a taxable thing and let's just pay taxes and not get into any hassle. Okay, so any questions, anyone? We'll go with a couple more examples that will just make it clear. I have few more examples here that we can go over. If no one has any question.
Excuse me, ma'am.
Yes.
As such, no questions. I am clear with the concept, but is this a valid way to calculate? I mean,
Is this a valid way for what?
like because generally we take FMB into consideration.
Correct. So, yeah, generally you say you take FMB. You're also there taking FMB. FMB is the base, but we also have to understand what is the basis, do a comparison. And now, is it valid or invalid? It all depends on what law is created. Like, yeah, one can challenge that this is not the way you should go for, but this is law. Like, we cannot put in. I mean, this is how they wrote it, so we just have to follow that. It's not a natural phenomena occurring that we say, no, this is how it should be, right? It has been written in the code. So we need to understand what are the rules that they're writing and follow that. Yeah, some people may think it's not logical, it's not valid, it should not be like this. That's fine. The law is also evolving. Maybe a lot of people go to the Supreme Court and challenge that law. Maybe the new bill will be passed and they'll amend the act. But right now, this is the law and it has been, accepted.
Right, ma'am.
Okay, so let's go over a couple examples. This will just make it clear. And
एग्जांपल आ रहे हैं
so, okay, this is the first one. I just put in some examples here. This is the first one. And now everyone, I please want you to pay attention. Write it down in your notebook and try to participate, try to give the answer. It's more fun when, even if it's wrong answer, that's completely okay. Don't worry about that. Wrong or right, we're not. At least if you participate, I know that at least you're able to understand something. It could be completely wrong, that's fine. Okay, but don't be shy. Try to give in your inputs. So let's say the first example here we are saying when the gift is happening or when the property is gifted, that point of time fair market value is $20,000. Adjusted basis is $15,000 for that property. So fair market value is higher than basis, correct? These rules will be applicable if the fair market value is less than the basis. But we are in this situation, we are seeing fair market value is higher than basis, and it is sold later on for 10,000. Let's not get into whether it's long-term sale, short-term sale, and all. Let's not. We are not worried about that part. Okay, we just want to focus on what is going to be the basis for this gifted property. So how the tax is calculated, that's different. So it got sold for $10,000, and let's just assume there's no gift tax paid on. Why am I writing there's no gift tax paid? Because if there is a gift tax paid, we have to increase the basis. They have to increase the basis for any gift tax paid on the appreciation. So let's make it simple. Let's keep it very simple. We are not talking about gift tax. Don't worry about adjusting the basis. All we are saying is fair market value is 20,000. Basis for the donor is 15,000. It got sold out for $10,000. So what is going to be the gain for the donee?
10K.
Loss, there'll be a loss.
Loss of 10K.
Is it going to be a loss? It is going to be gain.
There'll be a loss of 10K.
10K loss, okay.
Huh?
And can you explain how?
Because the property is transferred at loss. And when it is transferred at loss, we need to go by FMV on the date of gift. That is 20K. And sold for 10K.
Okay. No, I don't know why they have not put it here, but there should be something that talks about what value to take.
So it's given कि when FMV is less than the donors, but in our case it's higher.
So you don't go with this situation because this situation is applicable when FMV on the date of the gift is less than donor's basis. So FMV is more than donor's basis here, right? But okay, there is one rule here that I should have put up. But what it says is whenever we are computing a loss, okay, this is a loss completely. This is a loss, right? Whether you compare it with this amount or this amount, it is going to be a loss. So in the loss situation, we have to take the lesser of adjusted basis or fair market value. Because IRS again wants to be consistent here. What is the gain or loss? I think.
Yeah. The donee has dual basis to the property, which minimizes the gain or loss.
Correct. Not recognizing the subsequent transfer. But that's okay. This this is a different condition, but generally what happens, the loss is also going to be limited. So we'll have to take the lesser of fair market value or adjusted basis. Okay, we cannot go with only fair market value because it's a loss situation. So the loss has to be limited. Okay, when computing a loss, the donor will assume the lesser of fair market value or the donor's adjusted basis. The lesser of these two is 15,000. The 15,000 minus 10 is going to be a loss, 5,000. Okay. This is not that situation what we are comparing. I mean, they should have written that, but usually maybe they are missing it here. But yeah, usually we will go with we'll have to take, if it's sold later on for a loss, we'll have to see how do we how do we be conservative? How do we minimize that loss? I mean, as per IRS code, they don't want to give, they don't want to allow so much loss to be claimed. So the rule that they have put up is you take the lesser of fair market value adjusted basis. So if we are taking lesser of any of them, then obviously the loss is going to be less only. Okay.
So
Yes.
here the loss will be
This is
5K.
Yeah. So it's going to be 5K. Because we have to go with lesser of.
Got it. Because FMB is more than adjusted basis, right?
Then if FMB is less, maybe we'll see one of the example here. If here FMB is less than the basis, then we'll see what happens. But let's go to the
Okay.
next one. Here FMB is $20,000, adjusted basis is 10,000, and it has been sold for 15,000. Again, no gift tax. We just okay. Here we can see we first will calculate what is going to be the basis. Then obviously once we have the basis, then we need to know what is going to be the gain or loss. So okay, let's think about it this way. The fair market value is $20,000. Basis is 10,000, and what we need to see is what is the basis for the donee. Donee has later sold it off for $15,000.
I'm 5K gain.
5K gain. Okay. So what is the basis that you're using now?
Donors basis.
You're going with donor basis. If you go with FNB, then the gain is going to be, even then it's going to be a loss, right, for 5K. Okay. So let me just go over this again. So basis of the gift which has been received is 10,000. Fair market value is 20,000. Since the fair market value exceeds the donor basis, fair market value is exceeding the donor basis, we should use basis of the donor. And here we are going to compare the basis of the donor with, that basis of the donor becomes basis for the donee. So her cost becomes $10,000. She's selling it for 15,000. So there'll be 5,000 gain. So this is how we are also being conservative here. If we go with fair market value, then that means she is selling it for a loss, right? If we just compare fair market value with the selling price, then it comes to 5,000 loss. But again, both these situations, fair market value is higher, so we have to take the lesser of fair market value on adjusted basis. Okay. Let's go to the next one where fair market value is going to be higher than adjusted basis. And it is being sold for $75,000. Fair market value is 60, basis is 80,000. Later on, it is sold for 75,000. What happens?
No profit, no gain.
Perfect. No profit, no gain because it falls in that range between the fair market value and adjusted basis. And the reason why we are putting these rules is because fair market value is less than the donor's basis. These two situations are different. Okay, here the fair market value is higher, so we will take lesser of fair market value or adjusted basis to calculate our gains and all. And here the fair market value is lower, so we'll have to see, but it got sold for 75,000. 75,000 is between this range, between 60 and 80. So there will be how much gain or loss? Nothing. Zero. The taxpayer doesn't have to report anything. Now let's look into this situation. Fair market value is $100,000. Okay, I have put in this thing. A adjusted basis is 40,000. And $14,500 has been paid as gift tax. So what is the basis for the donee? Right now we want to calculate the basis. Don't worry about the gain or loss. But now there is a gift tax element here. And what they say is if the gift tax is paid, then we need to increase the basis by the gift tax paid, which is attributable to appreciation. This is the formula. So, can anyone compute that quickly? What is the gift tax paid?
14,500.
Okay. Times, what are they saying? Fair market value. What is the fair market value?
100,000.
Minus this basis is 40,000.
What is the 60,000?
Divided by, we have to see what is the appreciation. This is the appreciation because fair market value has gone high from the basis. So this is the appreciation. How much of that gift tax is attributable to the appreciation? So what we say is, okay, we will divide it by again fair market value. But there is an annual exclusion. This amount is completely free of tax. So the annual exclusion amount get reduces the fair market value.
Okay.
And that's how we may, someone can do this calculation. Or maybe what we can do is we can just put 15,000 just to have a round up number or something. How much does that come to?
85, 89, for 60 by 85.
60,000 divided by 85,000
It's 0.7.
times 14,500.
And that is coming to be 10,235.
Okay, 10,235. So this is going to be the adjustment to the basis. Adjustment to cost basis. And so now what is going to be the basis here for the donee? She's not selling or buying it and all. But the fair market value is higher. So you don't have to go with these rules. Here fair market value is lower. And when the fair market value is lower, we look into the loss basis, gain basis and all. We don't need to worry about that. Fair market value is very high. So what is that lesser of these two that we are going to take for her basis? Lesser of these two, what is going to be that number? 40,000, right?
40.
And we will increase it by how much?
10 to 35.
Correct. So now her new basis is what is? If there is no cost, if there is no gift tax paid, well, we'll just take lesser of these two. But if there is gift tax paid, we have to see what we cannot take full gift tax, right? Because when 40,000 is anyways there, we have to see what is the appreciation on that property. Plus, we also need to factor in that anyways $15,000 or $16,000 will go for annual exclusion. So we also need to factor this amount in and then come up with that. Again, so when we are working on the software, all these calculations will be done. We'll probably need to just put in. The software knows what is the annual exclusion amount. Maybe it will ask you what is the fair market value, what is the basis, these calculations will be done automatically. And the basis becomes 50,000 for the donation. Okay, we cannot become an expert in one class. Fine, everybody understands that, but we need to know what are the rules. So when you get into this kind of situation, there is a gift tag. The client comes and says, "Well, I'm planning to get, and this is very very common. A lot of our clients, they come and tell us, "Well, 20 years back when I was in US, I bought a property, but I could not buy it in my name because it's an agriculture property, so I bought it in my mom's name. Now I want to get that as a gift." Right? The mom is getting old or whatever, they want to sort out their properties and everything. So now it's like, okay, maybe I want to just take that as a gift. We will see this situation a lot. So we need to understand how the gift tax works, what will be the basis, and we need to tell them that, okay, whenever you get into a gift agreement, also keep these basis calculation also along with that. So after some time when you are selling it off or you are passing it on to your kids, they can also know what was the cost basis for you. because they will take that as the basis and then it gets transferred to them. And then if they are planning to sell it off, they can do the correct calculation. Else, we just have to go with the worst possible scenario and pay highest tax as possible. Okay, so we'll close it here.